Welcome to Monday Morning Coffee with Inside the Firm. Each week, our hosts will be interviewing local, regional, and national business leaders to give you an inside peek into how they lead their business to success in the ever-competitive business climate.
Welcome, everyone, to a Monday morning edition of Inside the Firm, Monday Morning Coffee. I'm Alex Gore. I'm here with John Klaassen. John is, to be transparent, he's our insurance guy for architecture and for contracting insurance. I know people like me don't like to think about insurance that much, but it is very important. And there's different policies, and then there's different policies for architects versus builders. So we're going to do an overview. We're going to talk about that and kind of lay it out clearly so that people know what they need, what they should be looking for, and what's involved. John, welcome to the firm.
It's good to be here.
Tell us a little bit about your background and how you got in insurance and how you started Lightship and what that's all about.
Well, sure. Out of college, I was working at Campbell Soup Company and loved the company, didn't like the work. I was bored. I wanted to do something more entrepreneurial. And so a headhunter came to me and I started looking at different opportunities. And I ended up going into commercial insurance with Liberty Mutual almost 30 years ago. I wasn't planning on going into commercial insurance. I don't think a lot of people wake up one day and say, hey, I want to become an insurance agent. But I found the field to be very dynamic and I get to work with a lot of different types of businesses. Been doing this for 30 years now. And about 13, 14 years ago, I decided to start Lightship Insurance. I'd worked at a direct writer firm before that, but wanted to continue with a more broad perspective that commercial lines has. And at my other company, I was more focused on personal insurance.
Gotcha.
So I started Lightship Insurance 13 years ago, and it's been a fun run. It's been great. We focus specifically on construction. It's our biggest area that we work on. It probably is a tribute to my father, who was an engineer. And so I've always been around a lot of construction most of my life.
Yep. And I'd say that's key too. If you're looking for someone in insurance, if there's someone that specializes in your area, it's way different than someone that doesn't. It's I don't know. I wanted to make a light speed away joke, but it didn't come.
That's all right.
So and are you mainly just Colorado?
Yeah, so we are focused, the firm is based out of Denver. We are focused really just primarily in Colorado. We have a few other surrounding states that we work with, but primarily our focus is here in the great state of Colorado.
Awesome. Okay, let's talk architecture, and let's talk maybe the simplest form of insurance, which is general liability insurance. What does that cover for an architect? What does that do for you?
So we want to break it out a little bit. There's going to be some differences between an architect and a builder. So let's talk about the architecture firm first. As an architect, you want to make sure that you've got your general liability in place for any work that you do associated with construction itself. Now, sometimes as an architect, you may not be directly involved with that, but you still have indirect connection to that. So if something goes wrong on a project that's being built, we need to look at what's going to cover that, and that's going to be the general liability policy. So the general liability policy is probably best to first explain that a little bit, and that's going to cover a few different areas. The one that we think about is going to be the premises liability. There's $1 million usually on most policies for premises liability. That's going to be what we see on a certificate of insurance a lot of times as general aggregate limits, and there's going to be $1 million per occurrence, and then a general aggregate of $2 million. It's going to be a really common limit.
And that's basically. So I'm just going to say, even though Lance owns the firm with me, but my architecture firm, if I have this building, someone comes, something happens. Is that what you're talking about? Basically, like right. Homeowners, kind of.
Yeah. So here I am sitting in your offices, and that's going to be a premises exposure. So if I get hurt when I came into this office, tripped and fell, something like that matter, that's going to be your premises exposure. Okay.
Yep.
The next part of a general liability policy is going to be the products and completed operations exposure, okay? So for an architect, there's probably limited on that. That's going to go more into something we'll talk about later, and that's going to be the professional liability. But there could be something that you build. If you're involved in the building process, and sometimes architects do get involved in that as well, especially design build firms, then there's the general liability exposure associated with products and completed operations. So that's going to be something, maybe step out of the architecture world for just a second. Think about somebody who's building widgets is the crazy stupid term that I think is used. But let's just say you're building a car, and
or furniture pieces.
Or furniture pieces.
Our architects can want to make furniture all the time.
Right. So yes, if you build a piece of furniture and somebody sits down in that chair that you just built and that chair collapses, that's going to be a product or completed operation. Yep. That's a different type of exposure. So those all fall under the general liability area of coverage from an insurance standpoint.
Architects mainly make plans, and a lot of times it's just digital, but it's also paper that's shipped out. Is general liability, because you can fall in a chair, that you make, but does this cover anything to do with plans?
No. So really with architects, our biggest exposure that we look at for architects is going to be the errors and omissions insurance. And here I'll try to clarify something that really is really confusing for a lot of people.
Yeah.
There are some technical differences between errors and omissions, malpractice, and professional insurance. But for most people, it's just better to assume that they're all the same thing. So professional liability, malpractice, E&O, errors and omissions insurance, they're really the same thing. They're going to cover...
And just to wrap up, so general liability, think about that as your general policy, just like a homeowner's policy. I know it's not exactly the same, but that's how you can wrap that in a bubble for architects, right? And then professional liability / E&O / malpractice, that's the next bubble, and that's kind of covering what an architect is actually doing. Is that correct?
Right.
Okay.
No, that's a good way of looking at it. So yes, for architects, we are much more concerned about the professional liability than we would be for the actual construction project.
And last question before we move into the second bubble, general liability, how are costs determined for that?
General liability, the most typical rating basis will be 3 things, okay? But for an architect, it's a little bit different. We're going to it's going to dwell into a little bit what it would be for, maybe say I'm a builder itself. So for a builder, they're going to look at his sales, his subcontractor costs, and his payroll.
Well, can we go into builder later?
Yes, but I'm just trying to keep it. It's hard to separate them out sometimes. That's all.
But I can't remember. Our policy was in the thousands. I'm doing orders of magnitudes.
Right.
There's things that are $10,000. There's things that are $100,000. There's things in the thousands. So general liability is more in the thousands. And for an architect, how is that calculated just for an architect?
Usually it's going to be a sales-based exposure for the architect.
Gotcha.
Yep.
Okay, great. Professional liability. This is the big one for architects.
Right.
You have to have the general, but now you're going into what you're doing. What does professional liability, malpractice, what's that whole bag?
So we have the general liability that we just went through, but then for an architect, the biggest exposure is really you're designing an idea. You're providing an idea. You're not actually building that idea. But because you're giving that idea to people, and it's coming in a format that it requires a little bit different insurance, because you're not actually providing the product, you're providing the design for the product. So you're not creating the product, which is what a general liability policy really covers. Remember, it's covering the product itself. You're providing the design. And so if something goes wrong with the design and it fails, the classic example we often use in insurance is the guy who designs the bridge that then collapses.
Yep.
So you didn't build the bridge, right? Your firm may have given the design for that, but you didn't actually build it. A construction company built it. But you're at fault for it because you didn't design it properly. So it collapses. That's going to be your professional liability, the malpractice insurance. You made a mistake.
Yep, an error, an omission.
Exactly.
All of that.
So we need to cover that for an architect, and that's the biggest exposure because we are relying on that architect or engineering. We often combine the two, by the way. It's hard to sometimes separate, and a lot of firms combine them as well. We'll often call it architecture and engineering insurance.
Okay.
What we'll look at. And because we're going to have the design itself, but then we also have to have the engineering to make sure that the design holds up and it can substantiate or hold the weight of a project or whatever it is requiring.
If an architecture firm is purely architecture, do you put in structural too or not? And the reason why I'm asking this is because let's say it was purely a structural failure, right? Or I remember there was an opening for stairs that was right on the drawings, but one thing wasn't sized right, and then the contractor did something different. They sued everyone anyways. Like they sued the architect, because they're like, you should have been on site. They'll just make up reasons. Mm-hmm. So But to stick to the question, if it's an architecture firm only, do you see policies that cover the structural for the architectural drawings?
Well,
or no?
What happens if you're an underwriter for an insurance company, you're trying to write an architectural firm, it's going to be so hard to split those hairs between the architectural side and engineering. You're actually going to usually have it be one and the same.
Okay.
So what we're going to do is you're going to get an application, if I were say to come to you and say, okay, Alex, you want new insurance? We'll go ahead and set up your architectural insurance. Here's this application. The first thing you're going to see on the application, it's going to probably say architectural and engineering insurance application. It's going to be combined. It's going to be very difficult to separate those out because of the way the real world works, and that is something an architectural design error or was it engineering? It's going to be hard to split those hairs.
Because everyone's working as a group. So It's like now I'm just blaming the group.
Right.
Yeah.
So if you're hiring an engineer, we're going to kind of just assume they're working for you, right? That's kind of going to be how we look at your insurance.
That makes a lot of sense too, because even if you want to say, hey, it's structural only, like, well, who hired the structural firm? Who helped direct and coordinate that? Who managed how many meetings there? What
Right. It's just too hard to separate, so we have to put it under one policy.
Makes sense.
Yep.
And then so that one I know costs more than the general. So is it based off of your sales also, and is it just like let's say I'm the whole firm and I'm $100,000. Mm-hmm. That's my sales. So general liability is just like a percentage of your sales, whatever that would be. Professional, is it the same?
Yeah, so on professional liability, we're going to usually look at just your sales, and we're going to want to break it out. We're going to want to have enough details. The basis for the policy is going to be what we actually rate on, but they're going to ask more questions. We're going to want to know about your whole firm. So we want to know if you're a firm that does some design build, then we're going to want to separate that out from your architectural exposure because, of course, that's different exposure than your architectural exposure. So we're going to base it on your architectural sales and design. That's what we're going to really focus on, the premium for the professional liability.
And then it's percentages. We do this much residential. We do this much commercial. We do high rises.
Right.
Oh, okay. You do high rises. That's probably a different thing than a single family.
Right. So then on the application itself, we're going to start really breaking it down, getting into the more detailed nuts and bolts of what you do. Commercial work. What kind of commercial work are you doing? Are you doing condos? That's a big issue. Are you doing tenant finish work? They're all different types of things. Are you doing bridge work? It's obviously going to be more exposure. So they're going to look at that. An underwriter is going to look at what your exposures are based on the type of work that you do. And we're going to dig into those questions. So the application on an architect and engineering application is going to be very detailed. It's not going to just be a one-page thing you finish in 10 minutes. It's going to usually be 3 to 5 pages, sometimes even more, if you do some really tough, what's considered tough areas, like some of the bridge construction work.
And then foreshadowing for our listeners, we're going to come back to this because this is gonna, what you just said is going to circle back in the end.
Correct.
Okay. Anything else for architects? Do you want to touch on professional liability?
Without going too much into the whole thing, but giving a little bit of a better perspective, it's kind of good to understand how a policy pays. So a professional liability policy is what is called a claims-made policy. I'm not going to go into too much detail, but it's important to realize that your exposure on professional liability is going to always be based on this claims-made type of policy. So what that means is that when you start your policy, let's just say we started your policy August 1st for your professional liability, we're going to cover any claim that you have moving forward from that date. That date that we started the policy, if it was your first policy, it's what's called a retroactive date. Nothing's going to be covered before that. So let's say you've been an architectural firm for years, but you just finally decided to buy your first policy for August 1st.
Good for you. You listen to this podcast.
You're right. You're like, wow, I need to do this.
Yeah.
It's good to know that.
John, Lightship Insurance.
Yeah, we'd love to talk to you. So it's good to know that there's not going to be coverage for anything before that inception date or before that retroactive date. Bad habit, we get into saying retro. So if I say that, I mean a retroactive date.
Yeah.
So that retroactive date would be August 1st if you never had coverage before, and anything moving from that date forward is going to be covered, assuming you keep your policy in force. It's important to mention this because let's say you designed a building a year ago and it collapses tomorrow, or let's say it collapses August 10th, there's not going to be coverage for it.
You think you have insurance.
Right. But it's not going to make that retroactive date requirement.
Yeah.
So you may have had coverage. You may say it collapses in September. You bought the policy in August. You're not going to have coverage because that retroactive date is not going to cover you.
Yeah.
So you don't want to wait. You want to get your insurance in place. It's really, really important to get that in place. And so that way you have the coverage. It
Yeah.
is different than general liability. We'll talk about that a little bit later on. I'll touch on that, how that policy is a little bit different. But for a professional liability policy, we want to make sure we get it put in place so that we can cover you moving forward. And then you have to continue to keep it in place as well, so that way it's covered. So if you go out of business, that's also something. If somebody's thinking about retiring, you retire, that policy then also can retire because it is what's called a claims-made policy. It means that there's no coverage after the policy ends. So you want to keep that in mind too. It's also a little bit different than a general liability policy. So once you retire, say you retired January 1st, we can provide an extension to that policy called a tail to give you coverage after your retirement date. So that way, if something happens in the future, you're still covered. So it gets kind of complicated, I know that, but it's just good to understand claims made. It's something to look out for, and it's definitely different than a general liability policy because of that.
So I want to get into that, but generally thinking, the analogy that for some reason came in my head is birth control isn't going to work on your 2-year-old. It's going to prevent the next one, but not the one that you already had. Secondly is, let's say you reassess and you're getting a new policy or a different policy. You want to keep it continual, because if you have a gap, let's just say you have a gap of 2 months or 6 months because you just failed to do it or failed to get the next one, the stuff designed in that period is kind of
Alex, that's
at
such a good
risk.
point. So once you have a claims-made policy, it's super important that you never let it have any cancels or lapses.
Yeah.
For one thing, you'll really have a hard time getting anybody to go back to your original retroactive date. So in the example we were using earlier, say August 1st we started it, and now let's say we're 5 years from now, and you just got lazy 5 years from now and just didn't have the policy for 6 months because you just didn't renew it, or you were having a slow period. You're going to have to start all over again with your retroactive date. No insurance company is going to really go back more than 30 days on a retroactive date. So it's really important that once you put the policy in force, you never let it lapse, because that retroactive date is so critical, because you want to cover your past work.
So there's a small buffer just to get your paperwork done, your money in order, possibly, but you want to have it the next one set up before the one expires. There might be a month policy buffer. Don't bank on it, but obviously don't let it lapse for.
Don't let it lapse. It's always important to make sure that policy stays in force. I mean, as an example, the huge, terrible disaster that happened in the Miami condo collapse.
Yep.
Those things go back. It's so hard to even to tell when that is going to be a claim, because that thing was built 40 years ago. There was ongoing issues. There's just so much that's going on. That's been the classic example of issues in the insurance industry right now, of a bad situation on claims made, because you're looking at a policy that could go back 30 or 40 years. Some of those issues might have been original design issues and flaws.
Okay, here's a great question. What if it is that scenario and that architect or engineer either went to different firms or started different firms or switched from John to Bill, like he had you for 5 years and then for some reason is like, nope, I need Bill. Which policy picks that up?
That's why that one's going to be such an ugly situation and going to be in the courts for years, because it's going to be really hard. It looks like, from what I've understood in that situation, some of the flaws were going all the way back to the original construction.
Okay.
Some of the plans might not have been followed.
So if you do switch, and let's say you clearly designed it in 1 year with your policy and they didn't really change anything, there was just an error. In a more easy scenario, it does go to that policy, not to your current policy.
Right. So a lot of times it could go back to that old policy. Now, on the professional liability, what happens is a little bit different than general liability, is whoever has your coverage then, when there's a claim, is agreeing to pick up your retroactive date from the other policies.
Gotcha.
So let's say I was with company A for 10 years and then company B. Now that I'm with company B, they're agreeing, as long as they have that retroactive date on the policy, to cover those exposures from before.
So even if you did with company A, it's now 15 years later. Company B, that's who you deal with. That's who does it.
Yep.
Okay.
That's very different. This is specific to a claims-made professional malpractice liability policy. That's very different than a general liability policy. So they are very different in this particular area.
Okay, let's remember that on the builder side, because it's more important on the builder side than the architect side.
Right.
No, next question though. Let's say there's an architect out there or engineer, doesn't matter. They have all this. They're actually great. They're all set up. They're listening to this and they're doing everything that John says. They're going to retire tomorrow, and their policy is set to retire tomorrow. There's the idea, and I think you alluded to that. oh, there's this 7 to 8 to 9 years of construction defects, liability, all this. That architect that retires and is going to get out of it, how long does he have to keep insurance? Does it keep being that heavy one? If he was part of a firm, I know I'll make up a state to make sure it's not the state that this happened in. And it's not the current state we're in, but like I know there's firms in, I'm going to say Alabama. It's not Alabama, where it's a firm of, let's say, 50 people. The two principals are the only ones that are stamping. You know what I mean? So that means the amount of work that those two principals are stamping for is massive. So if one retires and that person is just at like a normal salary, that's a lot of risk for half of a 50-person firm.
Right.
So
we want to insure the firm, Alex. That's important because we want to make sure we're covering all that exposures and that it continues on. That's the best thing we can do is if somebody retires and the firm stays on and it stays on as an ongoing concern in the same name, then we can discontinue the policy. If we don't, if you have somebody retiring and they're closing shop or the new entity buying them is going to have a different entity name or a new legal name, then you have to buy what's called a tail policy. And for an architect, that's a really important thing to make sure you do. And usually we would recommend at least 3 to 5 years, if not even longer, depending on the scope of what your history has been.
Yep. So let's say you're at a firm and there's multiple architects and stuff like that. The firm has a policy. One person retires, another doesn't matter. The firm continues. It all goes. You're the leadership of the firm and it either dies or you sell it to Bob. Bob's a key figure in our discussion. He has his own insurance company. Now he's buying an architecture firm, but he's going to call it something totally different. That principal should have a tail policy.
Correct. If you don't buy that tail policy, any exposure that comes up from the past, any potential claims that come up from the past, those are going to be big issues for that firm that's selling because there's no coverage when Bob buys it and puts it under his different name.
Can we assume that tail policies are cheaper than what a firm is paying?
Yeah, so a typical rate on that is more expensive than people think because there's a little bit of fear from the underwriting standpoint, from the insurance underwriter standpoint, that what's there, what's hidden, that we don't know about. Are they selling for a reason?
Yeah.
So the firm policies for those can be pretty expensive. We often see anywhere from about 50 to 75% for a 1 year tail of what the original premium was. And then so a 3 to 5 year, you could be looking at even 200 to 250% of what a 1 year policy would cost.
Okay.
So if it's $1,000 policy,
let's say it's a $10,000
policy.
Yep.
Then we could be looking at, if you want to buy a 3 year tail, we could be looking at that being $20,000. If you want a 5 year tail.
For the 3 years.
For the full period. And you buy that policy, it's a one-time payment, just paid in full, and then that's done.
That's one. Okay. Good to know. I mean, that's huge for some people.
It is. I'm dealing with one right now. It's actually it's another environment engineering firm, and they're selling at the end of the month here, and they were a little surprised at how expensive it was to buy the tail. But that's because there is quite a bit of exposure that could still be out there.
Yep. Okay. Before we go to the next one, professional liability. Anything else you want to say about that on the architect side?
No, I think the most important thing that I just want to make sure people realize is that on the professional liability, that because it is a claims-made policy, that means that the claim has a trigger, because we're going to talk about that in a minute on general liability, and that trigger is when the claim is reported. So when the condo collapsed in Miami, the trigger was when the whole thing collapsed. That's the date that becomes the policy that's going to cover it, and then we look at the retroactive date for any flaws that were potentially happening, and that's a different situation. But the actual claim goes by the trigger date of when the incident happened.
Yep. Okay.
It's important.
For architects, workers' comp. What's that for? What's a general metric for rate people can kind of think about for costs?
Yeah, workers' comp for architects is pretty inexpensive. You've mostly got people usually in-house. That's going to be a very inexpensive rate. Not going to be very much money. We're looking at maybe 1/4 to 0.5% of payroll rate. So on $100,000 in payroll, we're just talking about several $100s. We're not talking about something that's very expensive. If you're out in the field a little bit, sometimes we see architectural firms that'll do some surveying as well. There's a surveyor rate. It's funny. I think we just asked you that question.
Yeah, and I was like, we don't survey nothing.
Yeah, but a lot of architects do.
Yep.
And that rate is a little bit higher. It's going to be out in the field. It's going to be more like kind of a salesman surveyor rate, and you're still looking at pretty reasonable rates. Anywhere from 0.5% to 1% of the cost of the payroll, because you've got somebody who's out in the field, and that's why it costs a little more.
Why are owners allowed to be exempt?
So under most states, they'll allow the owner, if they're at least 10% or more ownership, they'll allow the owner to choose to not be covered, because most owners don't feel like they need to be covered. They'll go ahead and take care of their own situation. And remember, workers' comp is covering lost wages and health insurance. So if you're an owner, you have your own health insurance, you're not as concerned about that.
Yep.
If you're an owner, lost wages, well, you're kind of getting maybe some payroll, but you're also maybe getting some dividend income or getting income elsewhere. So you're maybe not as worried about that. So a lot of times owners will go ahead and decide to not be covered.
Yeah. Basically, you're saying owners do zero work. So if they are out for 6 months, the rest of the firm will do all the work anyways. Everyone knows the firm's doing the work anyways. So.
All the minions are doing the work. Right? I don't know about that, but yeah. So that's kind of how that works. But yeah, so the owners are not very expensive to insure, because usually it's not a very expensive code. So sometimes we see people decide to be included, but a lot of times they decide not to.
Gotcha. Okay. That, for me, sums up the architecture side. Does that sum up the architecture side for you? Or I'm happy to go as deep as we want to go. This is very informative.
I think it's good. I think one thing to keep in mind on the work comp side, and we'll go into this more when we talk about the construction and builder side, but on the work comp side, I do want to stress that it's important to have coverage, even if you think you're just a one-man operation. I know there's going to be some of those people out there. And if you're a one-man operation, it'd be easy to say, I don't need to worry about it. But you want to be careful, because if you're involved in hiring somebody in any way, shape, or form, ultimately that exposure on workers' comp could come back to you.
Yep.
So it's always good to make sure that you have your own policy in case somebody ever tries to come against you for something. It's more of an issue for a builder, but can also be an issue for an architect.
Here's the thing, too. A lot of architecture firms are one-man shops, and if they want to owner exempt themselves, but take, for example, you play basketball and you break your leg. Well, wait, probably wouldn't cover that because you're playing basketball.
Right.
Right?
Has to be other work.
But I think you could get a different policy just for like Aflac or Life or anything like that. Think about it, if you actually are out of work, even as an owner, and you don't have other people making money in your firm running, you need to think about some sort of insurance for that, because you could be out for months. You could be on pain pills, typing emails like a crazy person that makes no sense, and your wife's like, please stop.
A disability policy would be a really good idea, if you're a single man operation. But even that single man operation, the reason I maybe just going out a little further is that even that single man operation is likely to have projects that come up that they might need to hire somebody out. I would imagine that, often, or I just know from my own history doing this for 30 years, that a lot of times you might have to sub out some of that work. You can't quite finish all the different things involved. And if you start hiring somebody else and have them do it, and they get hurt driving to a client meeting, and they're working mostly for you at that point, even though they're an independent contractor, that's the situation where you want to have that work comp policy, because it could be easily construed that they're an employee of yours. They're working for you, and you didn't even realize you kind of ended up building that relationship of an employer-employee relationship, and may not even realize you did it.
Well, that goes back to the state for unemployment insurance, which the state mandates and takes and all that, because we've had to deal with this. And what they consider someone working for you is fuzzy, and I don't want to go too into the details, but it's how much work are they getting from you? Like if you stopped, like would their income stop if that's true? And the weird thing is that they get to decide, because like, let's say we have engineers. Okay, let's say we send this engineer a bunch of work, but if we didn't, if anyone knows anything about construction right now, there is a lack of engineers. So that engineer would not be unemployed. He has a backlog of stuff. But insurance might say, the state might say, like, no, you need to pay unemployment insurance for that person.
That's such a good point, Alex. I think on that note, it's very easy to get in this mindset that, oh, well, it's a 1099, so I don't have to worry about it. Well, we've actually got to the point in workers' comp that we just call them 1099 employees. Well, that it's actually mutually exclusive, but because we separate the way taxes are done, don't get that mixed up with the way insurance is done.
That's the key.
That's really
taxes
really
and insurance are different animals.
Are different animals. So that's really, really important, because that 1099 employee means that from a workers' comp standpoint, they're going to be covered. You're going to be responsible for that 1099 employee from a work comp standpoint.
Yep. Okay, let's jump over to the builders/contractor side, right?
Yep.
So the main difference, I would say, is if in an architecture, your meat and potatoes is professional liability because you're doing those drawings or those professional services. The contractor side, that's not really happening. Your meat and potatoes are general liability because you're making that widget, that house. Is that the way to think about it?
Absolutely, and that's the key. Is that you're now implementing what the good architect hopefully designed.
Yep.
You're implementing it. You're not really very involved in the design process. And unless you are involved in the design process, you probably don't even have any professional liability. And you probably don't need it. Most contractors don't have professional liability, but they need to have general liability.
Yep. I'm just... Say something?
Testing?
Perfect.
Okay.
That's fine if that's in there. I just wanted to make sure because I'd hate if this conversation was not recording the way it should. So it did pick it up. Perfect. Okay, so general liability is huge for builders. I think you kind of went over it, but if in any more detail, it covers it. Hey, it collapses.
Right. So can I jump in?
Yeah.
Yep.
Yeah.
Yeah. So just to jump in again, super quick summary. While the job is being built, that's going to be that premises liability, and that's going to be covering. So somebody falls and gets hurt, or somebody gets hurt on the job. That's going to be the premises liability. But what we really want to cover, and what's going to drive the rate for a contractor, be it the general contractor or a trade contractor, it's going to be the exposure they have on the products and completed operations side. So what under Colorado law, and most states have something similar, but under Colorado law, we have what's called the Statute of Repose. So you may say, a contractor may say, I'm only going to give a 1-year warranty or a 2-year warranty, but under Colorado law, it's a 6-year warranty for construction defect. There's then also 2-year statute of limitations, and that statute of limitations is going to really make it so that the policy has to provide coverage for 8 years total. Mm-hmm. So that's Colorado law. It's all done on an occurrence basis. So this is the big difference between the professional liability and a general liability policy, is everything here is going to be looked at on an occurrence basis.
What was the on the professional liability called?
That's a claims made. Yep. So that's a claims made. So on on general liability, it's an occurrence basis, and what that means is it's going to be it's going to be when the project was built. That's going to be what we really look at. Okay. It can get a little fuzzy, but for the most part, 95% of the situations, we're going to look at when something was built. So if I built something in 2010 and it now collapses, well, let's not go that far back. If I built something in 2020 and it collapses because I didn't build it properly, then there's going to be coverage for that going back to the policy that was in force during 2020. Okay.
And then by built, because sometimes, does that mean completed or started?
That's sometimes where it gets a little confusing. That's a good point, Alex. That's where we have to be a little bit careful, especially if you change carriers, it can get a little messy. But yes, it's going to be usually when the work was done. Sometimes it can be over a period of time. That can get a little bit confusing. So sometimes we will see more than one policy have to respond. Let's say if something was started in December of 2009, finished later in 2010, whatever the year is, we're going to look at those different dates, and those are going to be the dates that we get used.
Okay.
So it's going to be based on when the construction was done. That's going to be the date of really the kind of the trigger of the policy under an occurrence general liability policy.
Yeah. How is that fee based off of how much it costs? Is it how much so let's say I'm a general contractor. Let's say I'm going to make $10 million worth of buildings. Obviously my firm is only going to do some of the work. A lot of subs are going to do the other work. Does that come into play?
Right. So the general liability policy's rating basis is usually going to be 3 things, and it's going to be a little bit different depending on how the carrier does it. Each carrier does this a little bit differently. We're going to always look at sales. That could be the rating basis exclusively, but we could also be looking at subcontractor costs. Oftentimes it's a combination of both. We want to see what your sales are. Say they're 10 million. Maybe you sub out $1 million. Maybe you self-perform $1 million. So we might even rate also on your self-performing, which then that would actually be based off of your payroll for in the field. We're always just really concerned about the field payroll. We're not really worried about the architect. We're not really worried about your clerical guys. Those are exposures that are just so minimal that we're not too worried about them. We're going to base that payroll on the field payroll. So those are the three things that are going to always be looked at on a general liability policy for a contractor. It's going to be sales, subcontractor costs, and payroll.
And subcontractor costs and payroll should add up to sales, or is there another gap that we're missing?
Well, you're going to have your margin in there. So that's going to be one of the reasons the insurance company is going to look at that. If they see $1 million or $10 million in sales and only $1 million in sub costs and only you self-performing $500,000, that's an awful lot of margin.
Yeah.
So that's going to be a red flag for them. That's why they're going to always want to know, what your exposures are for those three areas. The actual policy might be based on just subcontractor costs and payroll, or it might just be on sales. But they're going to always want to know what those all three are. And then we're going to have some margin in there too. And the assumption in the industry tends to be anywhere between 20 and 30% for margin.
But 20 to 30%. Here's what's kind of weird in my head. So I'm going to use very simple numbers. $100,000 in sub costs. And then $100,000 in payroll, right? Because payroll is one of them. But a lot of times in payroll is half of what you charge, because I rent a building, I rent equipment. There's other things involved. There's profit in there, and then there's $100,000 in material. So let's just say, and we could use millions, so that's $3 million. But your payroll plus your subs could only be 2/3 of that.
Yeah, it gets really complicated. So these are just general guidelines, but if you had $10 million in sales and $5 million in subs and payroll, nobody's going to bat an eye at that. That's going to seem within reason. But if you've got numbers that are not in line, that's what they're going to look at. But we usually assume margin, and I mean by margin above those fixed costs. That's more for profit and overhead. It's just a general guideline. They're going to want to make sure they see all those numbers to make sure they kind of add up to a certain extent. They're going to have metrics behind the scenes that they're going to run to kind of know whether or not they think you're running all your numbers properly. Yep. I've been doing this a long time, and I've had this conversation, believe it or not, with people, and they say, well, which books do you want me to see? My taxes that I send to the IRS, the taxes that I send to my accountant, or the taxes that I show to my divorce attorney? It's like, okay, which one is it? They should all be the same books, right? But that's what they'll do sometimes.
Well, what's hilarious about that is I haven't looked into this, but Amazon paid $0 federal taxes because the way that they reinvested and stuff like that, that's what they have. But somehow, every time they have their quarterly report, they report to their shareholders, we made $10 billion. Yeah. So you made $10 billion times 4, you made $40 billion, but those numbers that you give to Wall Street somehow do not match what you told the federal government. Yeah, did you make $40 billion or did you make $0?
Exactly. By taxes, I meant to say books. It's like, which set of books do you show? And it's like, wow, those sets of books should be the same, you would think, but they sure are not. So that's what's kind of scary sometimes.
It's crazy. It's crazy. And the reason why I kind of went into those weeds is because when we first started talking, not first, but redoing stuff, I just remember those numbers, and then you finally asked for payroll. And I was like, okay, because sometimes their calculations is based off of payroll. And if I put in all my material costs in that and all my, overhead, for example, let's say payroll is being charged out at $50 an hour, but they only make $25, right? Well, that's 50% right there that if I would have included that extra $25 per hour, I'd be charged for more than I'm actually paying people. So it's good to know payroll is separate from this.
Right. And it's always going to be the payroll that's in the field. That's going to be the part they look at for your own exposure. And then on sub costs, it's worth noting something you just kind of touched on there, is it's supposed to include labor and material. But I've even dealt with over the years auditors that don't even realize that. And of course, what most of the contractors like to do is only present what the sub costs are based on pure labor, not materials, because they don't want that extra hit. But technically, it's supposed to be labor and materials.
Okay, good to know. Perfect. General liability, does that sum that up?
Yeah. So the good thing on general liability is it gives you a lot of coverage for a long time. That's basically almost 8 years of coverage, and it's something that you don't want to do without. That's for sure.
Yep. Workers' comp.
Workers' comp. Actually, can we touch base on one other thing that comes up sometimes on construction, and we'll talk briefly about what's called a wrap project. And a wrap project is kind of something that gets a little more interesting, and wrap project will make a little more sense.
Slash umbrella.
Well, no, a wrap project is going to cover the whole project. And so what happens in Colorado, we're going to talk about exclusions later on, but it's tough. Do you talk about a wrap project now, or do you talk about it after you've talked about exclusions? But a reason I like to talk about a wrap project now is it's another form of general liability insurance. And it's an insurance policy that's called an OSIP. It's called an Owner's Contractors Insurance Program, or it's called a CSIP, which is a Contractors Insurance Program. And so we usually see a wrap, and we just call it a wrap for short. And that's a project policy that's going to cover all the insurance exposures for a project. So if you're building, say, condominiums or townhomes, especially multi-units, we're having a hard time getting coverage today, especially in Colorado, but other states are having this as well. So what we do there is we insure the whole project. So instead of having a policy be covered by the general contractor, the architect, and all the subs, we have one policy that responds for the whole thing. Yeah. And so that's, I think, a really, I won't go too much into it, but it's really nice to know that that's an option. So if you are doing some sort of multi-unit development, we at Lightship Insurance, we write wrap policies as well, and that provides coverage for the whole project and takes care of all 8 years of insurance exposure on that policy.
And normally, is it typical, because this is the way I've seen it, the developer would pay for that?
Correct. And that's why it's usually under an OSIP. That's where the owner pays for it, Owner's Contractors Insurance Program. That's usually the ones we see the most. And so usually the owner or the developer pays for that policy, and they're the ones buying it. So that way they're covered.
And I thought I had two questions about that, but maybe it got eliminated to one. So let's say that happens. It's a special project. It's a condo project. So then now I was going to say, the reason why that comes up a lot too is getting loans for that. A lot of banks or private people won't loan unless you have a wrap. So the developer has X amount of cash, has 25% of the project. He needs 75%. They said, hey, yeah, I'll loan you $4 million. Got to have a wrap.
Right.
And that's where I've seen it literally kind of be mandated by the money men.
Well, so the banks want to see it, and they want to know that there's going to be coverage because their money is on the line, right? So they want to make sure that there's proper insurance for that project. And what's nice about it is it gives a single line of defense. So rather than having to go after all these different insurance companies that are involved, the general contractors, the trade contractors, those get really complicated, those kind of claims. Yep. But here we have one line of defense. The insurance company picks it up. There's no questions on who's on it because it's insured through that wrap. What's also interesting about that, without going into too much detail, is that your contractors that work on that actually don't get charged their insurance premiums on wrap projects because the wrap is insuring that project. They can actually save some on their insurance. They don't have to actually get charged by their insurance company for any work they do on that particular project. And so that's a good thing. It helps it's important that if you do a wrap that you make sure that your subcontractors are aware of this so that way they're not being charged. And then some of the companies, what they will do for a wrap is go ahead and say, okay, we want to know what your rate is, and we're going to have a little bit of a charge back on your charges that you provide. I'm trying to think of the best way to word this. So what the sub may bid something at $100,000. So their insurance costs are usually 2%. Maybe they can contribute 2% back because they're going to have that savings. It gets a little complicated,
right?
Getting a little too much in the weeds here, but it's just good to know that there are some savings. And a lot of times the overall cost of a wrap policy, when that's taken into consideration that all the subs don't have to pay, the overall cost of a wrap can be very reasonable.
So, for example, let's say I'm a contractor. Let's say I'm going to do 3 projects this year. All of them are going to be 10 unit. Well, it doesn't matter. 3 projects. One of them I know for sure is a wrap. So then when I'm either renewing or at the audit, I can say, hey, this project that was $1 million worth of me out of my 3 projects, that gets excluded from my insurance.
Right.
Basically a third of my work that year in this scenario, I don't have to pay as a contractor because the developer's taking that on. So when the bullet comes, all it sees is the wrap. All's legally it can do is attack the wrap.
Right.
That's how it works.
That's a good example. I have a large HVAC contractor, And 90% of their work that they do, they do $6 million in sales. 90% of the work that they do is all under wraps. So their premium's really, really inexpensive. Even though they do all this work, their general liability premium's minimal because most of that is covered by the wraps. I'm only picking up the 10% they do on remodel work and stuff like that.
Gotcha. That was a good point.
The one other thing on a wrap to mention right now would be that we're going to talk about exclusions in a little bit. And exclusions are really, really severe on larger larger residential projects. So we're seeing a lot of exclusions on the insurance marketplace for residential projects. And so one of the reasons that your lender wants to see that if you're doing a big project is they want to see insurance that they know is going to really be in place. And a lot of times on general liability policies, we're seeing exclusions for new residential construction. And so that new residential construction is a real problem for a lot of multi-unit type of developments.
So that exclusion probably doesn't exist on the architect side because is that true? Or do you see that on the architect side too?
No, that's different. The professional liability is usually not going to have that exclusion.
Yep.
But the wrap is really meant to cover the general liability portion of it, the products and completed operations exposure. That's what the wrap is really there for.
Is a wrap the same as umbrella insurance?
Nope. So the umbrella is different. So if you have a general liability policy, those standard limits, I think I may have alluded to earlier, are $1 million per occurrence,
Yep.
$2 million in aggregate. Okay, that's just the general liability base. An umbrella policy is going to then provide coverage above and over that, and it's going to provide coverage of whatever limit you choose, starting at $1 million above and beyond. And it's going to cover over the general liability policy. Also, will cover over the commercial auto policy, and even the workers' comp as well, if there's ever a situation where that comes into play.
Okay. So a wrap it's basically wrapped up in a safety net. An umbrella is against additional, like it exceeded.
Right.
So
an umbrella is going to sit on top, and it's going to have the underlying coverages below it. That's why we call it an umbrella. It covers those other areas of exposure.
Okay.
But it's different. It's just higher limits of coverage. A wrap is covering a specific project.
Yep. Awesome. Okay, now workers' comp.
Okay.
Workers' comp it's just more expensive than on the architect side because they're actually doing the work.
You got it. So, you've got all those people swinging hammers, and that's expensive.
Yeah.
Carpentry construction, particularly on residential construction, is going to be anywhere from 8 to 10, even 11%, depending of payroll costs. So it's expensive. It's going to be less expensive in certain areas. We always are looking for workers' comp. We're looking at what the person does. And then we put that into a class code to then establish what the rate is going to be.
Right. Are they painters, electricians, general contractors, framers, general carpenters, framers, blah, blah, blah. Okay. Actually, I want to rewind.
Okay.
Since you said it's getting hard, there's exclusions for single family or for residential construction. Let's say a developer is doing 50-unit development of single-family houses. They could be custom, it doesn't matter, or it could just be tract homes like, normal neighborhoods. Are those developers now doing a wrap on like all of that? Or are they making sure that whoever their contractor is doesn't have that exception? And is that... Yeah.
Yeah, it really comes down to mostly where we're seeing the requirement for wraps is the new residential area. So
in a big development.
Tract housing is usually going to be the big issue. So insurance policies are going to all be different. Unfortunately, there's no exact perfect answer here. But a lot of the general liability insurance policies that contractors get are going to have tract exclusions. Generally speaking, assume it's going to be more than 10 houses being built. So if you're doing some custom home building, that's going to probably not be a problem for most trade contractors. So the trade contractors buying insurance, they want to make sure that they don't have a residential exclusion for new custom homes. If you get a exclusion that's for 10 or more, that's going to be a tract home exclusion, and that's going to be very common. Condominiums, also very common.
But does that mean 10 custom? Like, could I do 10 customs just all over the place? Because tract is in the same neighborhood. You kind of just...
Right. Usually what they do is because it gets so confusing and we don't want to get caught up in too much of a fine definition, they'll just say no more than 10 housing units total, but everybody's got a slightly different tract exclusion on their policy.
Okay.
Every insurance company does.
Gotcha.
Okay. We sometimes see hard new residential exclusions. Those you have to look out for. So if you're doing the custom home, that I know you guys are doing, a nice custom home, you want to make sure that there's no new residential hard exclusion.
Yep.
Where we see that sometimes. It all depends on your trades. We want to make sure that they don't have a hard exclusion for new residential.
Yep.
Just depends.
And I would say that all of this information is why it's important as an architect or a builder. If you can find an insurance person that they specialize in this, then they know to look for this. They know what's overlapping, what's not overlapping, where your gaps are, what's the exclusions are. You might have paid a whole bunch of insurance and if it had that exclusion and you realize 2-3 years later, holy cow, all the stuff that we are doing is now was always excluded.
Right.
That could be heartbreaking.
Yeah, you've got to really look at that. You want to know what, the insurance certificate that you get from your trade contractors, you want to make sure it's worth the paper it's printed on. If you're doing residential work, new residential work, you need to make sure that there's not an exclusion for new.
Yeah.
And I've seen it. Over the years, I've seen insurance agents, even know what the insured is doing and sometimes just move forward because they aren't connecting the dots.
Yeah. Okay. Want to go to builder's risk?
Sure.
So,
Actually, can we stay focused for just one more minute
Yeah.
on exclusions? So I think that's just good. I think we kind of hit on that. We kind of indirectly just started talking about exclusions that come on a policy that a general contractor will have or a trade contractor will have. What you also want to look out for is making sure that you have no exclusions on certain areas. And the other one that we see is earth movement. So we want to be careful with earth movement exclusion, and that's particularly important. So if you're doing a design build project and you are overseeing that from a GC kind of standpoint, you obviously now know that you need to make sure that there's no new residential exclusion if it's a custom home. If it's a tract project, you're probably having to put that on a wrap policy because there's going to be an exclusion for anything 10 units or more or for condominiums. But then if they're doing, let's say it's your contractor that's doing concrete work or foundation work, you want to look out for any kind of earth movement exclusion. So that's a standard exclusion. You don't care if it's on the painter's policy. You don't even care if it's on the roofer's policy, but you want to make sure your foundation guy does not have that exclusion. And we've seen that a lot. So your concrete guys, your foundation guys, that's really, really important. Other exclusions to look out for are not a big deal, but you still want to think about it, would be asbestos, not much of an issue anymore. But the one that still comes up is EFIS. So EFIS insulation still being done on some custom homes, still being done through various stucco projects. And so we see that sometimes come up on custom homes as well. And it's a very standard exclusion. So those are the ones I think that are probably the most common and to look out for.
So GCs generally sub out foundations, but some GCs will rent a Bobcat, do final grading, whatever. Is moving earthwork normally excluded on GCs, and should they look for that? Because does just getting a Bobcat and moving some dirt around count?
You want to look out for that for sure. It's often something that we'll see excluded or we'll see limitations on. So you want to make sure you have your full $1 million limits. I know one of the companies we like to work with, they were getting hit with too many claims and they put a 50,000 limitation on it. It's not a lot of coverage. You got a foundation issue. So that is something as a GC you want to look out for.
Yep. Okay, those limits, are those per year?
So it's per accident. So when we talk about general liability, we usually are looking at per occurrence. So it's per incident that happens.
But so let's say it's $1 million per occurrence, but it was 2 million. Normally, that's the numbers I see. 2 million in it. What does that 2 million mean?
That second, let's say you have had a really bad year.
Yeah.
You had a $900,000 claim, and then lo and behold, 3 months later you get another one.
Yeah.
That's where the aggregate comes into play. If they had another $500,000 claim, you'd still be okay. You have up to $1 million in coverage for any one incident, any one claim.
Yep. And
then you have up to $2 million for the whole policy year.
That's where I was getting.
Yep.
So
the aggregates for the policy year.
Gotcha. So that's where those tract homes, I can see the exclusion now, because if it was the same problem in all of them, and you get hit, $400,000 times 10, you're at $4 million right there.
Well, yeah, and if there's a hard exclusion, there's no coverage. But that's where you can go through your limits pretty quick.
Yep.
So that's what you have to think about too. That's why you'll start seeing umbrella requirements. So if you're doing a big project,
yep.
Let's just say even a big custom home, and you've got that big custom home or commercial work, and there's no umbrella policy, you can see how somebody can go through their limits pretty quick.
Yep.
$1 million sounds like a lot of money, and it is, but you get a big claim, it goes pretty quickly.
Yep. Yeah. Oh, and the lawyers are going to try to take a third of that. So, that just ups the price. And they overestimate what it takes anyway. So
right.
Don't think it's true costs.
Right.
Meaning you're losing out on that money. Someone else is probably building it, and they're getting the money, and it's not going to cost as much as those lawyers said it was.
Right. You can burn through expenses really, really quickly. Not too much of a big deal on an occurrence policy, like a general liability policy. Brief tangent, this is something to consider when you are buying what's called the professional liability and the claims made policy. A lot of those policies will actually have the defense costs within the policy limit, not outside. It's just another thing to keep in mind. So what that means is if you've got $1 million claims made malpractice policy, you can rack up a lot of expenses very, very quickly on the defense costs. Those can go against. Thank you. They can go against the actual limits.
Well, on bigger things, you could have a defense cost of $250K, and that's a lot of your million right there.
Right. So that usually doesn't come into play on the occurrence policy, but that's a big, big issue on the professional malpractice area.
Yep. Okay. Now builder's risk?
Yep. Builder's risk. Sounds good. Let's go.
Okay. Who gets builder's risk? What is it for? How much does it cost?
So I've got going to build a custom home, and that custom home needs to have insurance for while it's being built. So now we're talking about property coverages. So we're not talking about general liability here, just the property while it's being built. So we've got this raw piece of land that we're going to put $1 million house on. We need to insure that house for $1 million. Now, who decides to buy that policy really kind of goes back to the developer. Usually it's going to be the developer or the owner who's going to usually buy that policy. But because they're not usually insurance savvy, believe it or not, most contractors or architects are more insurance savvy than the builder is.
Not after this podcast.
Exactly. They're going to usually be the ones that help to get the policy. So most of the times I'm providing a builder's risk policy based on the request from the construction company. And it could be a GC, it could be it's almost always going to just be the GC, I guess.
Yep.
It could be the architect as well. But the GC architect's going to come to me and say, hey, let's get a builder's risk policy. We're going to put that builder's risk policy usually in two names. We're usually going to have that name be the actual owner. So, Bob Smith, he's going to own the home. Whatever developer is going to be, that's going to be the name we put it in. And then we're going to also put additional insured for the construction company as well. So that way there's just better protection for the construction company. So if something's being built and there hasn't been a draw on it, we can go against the builder's risk policy on behalf of the construction company as well. So what does that really mean? That's a little confusing. Let's say we were halfway through building $1 million house. There's $500,000 of work that's been completed, okay? And say $400,000 has been paid out by the bank or by the owner. That $400,000 that's all now been destroyed in a fire, because we have this claim that say that's just happened, that $400,000 will pay out to the owner, and then the $100,000 that still hadn't been paid out on the draw would go to the construction company. So that's the $500,000 payout on, say, a whole loss at that particular
And which
juncture.
insurance paid that?
That's going to be the builder's risk policy. So if there was a fire, I'm just using that as an example.
Yep. Because basically the general liability sort of kicks in afterwards.
Yeah, so the general liability is only going to kick in if somebody's at fault. But if there's something that happens that's not related to liability, that's related to the property exposures.
Okay,
that's
so
where we're seeing that.
Here's the question, and this will probably clarify it. You're halfway through. Two scenarios happen. The wind destroys it. Just a tornado comes, whatever, destroys it. Or there's electrical fire, or the structural engineer drops a beam right through your whole building for whatever reason. So it's either an error by someone or the wind. The wind is builder's risk. The error is either the contractor's general or going down to those subs general. Is that
right? So there's going to be different things. The property coverages that are going to be provided usually are going to be for fire, theft, vandalism. There could even be something for the situation you described where a contractor creates an error and destroys part of it. That might be more paid out under general liability. But we're looking usually more at the property exposures, which are going to be the fire, theft, vandalism.
Yeah.
Might get a little bit more complicated if there's a general liability situation that causes damage. That's I think that'd be a whole different discussion than we should probably get into right now.
Yeah, but wouldn't that let's say I don't know, a beam drops through or something, or the electrical catches fire somehow. Then aren't we in the realm of that's either the contractor's insurance or the sub's insurance?
Well, so let's just use the beam situation. If the beam falls, it could be paid out under the builder's risk for the damage, and then the builder's risk insurance company, it's going to be different, is going to possibly subrogate that claim against whoever was at fault, is how that could be paid out. Or it could just go straight to the general liability coverage of whoever was at fault. Those get a little bit more complicated because we have two different insurance policies that probably need to respond.
Okay. Gotcha. I think we've covered most of the different types of insurance.
I'll add just a little bit more on builder's risk, because what also comes into play is if, let's say you're at a site, a job site. We also want to look at what's called inland marine. Insurance is a quick little side story. Insurance is not the most creative industry. So inland marine, people always ask me, what does that mean? So I just like to give my quick story about inland marine, really going back to ocean marine. Yep. So ocean marine was the old insurance. One of the first insurance policies that we had was if we were going to lose a ship at sea, what do? We better cover that ship. And that's what really helped to start insurance.
Yeah.
Insurance started with ocean marine and fire insurance. Well, so we insured a ship and we called it ocean marine. Made sense, right?
Yeah.
Well, insurance people aren't that creative. When we have it on land, we couldn't figure out what to call it. So we call it inland marine. It has nothing to do with the water.
That's hilarious.
But that's what we call it.
Well, who else? You want to know who else is not creative?
So,
the train industry. Like we are on a train. Anyways, the signals that they have go back to the British. It's the same thing. You know, when they honk their horns, it's basically signaling that this is the Queen's train. None of these trains are the Queen's trains. It's just saying I have the right of way. The width goes back to the Roman. It's like you guys did not reinvent anything. You just
yeah. So it's good to make sure you have your policies in force. It's hopefully not going to give you a warning sign. But hopefully a good insurance agent is going to tell you to make sure that you have your inland marine coverage as well. And so that inland marine is going to make sure it covers your equipment, different things at the job site, and it could even cover some installation exposure that you might have as well, in addition to the builder's risk policy. So we will sometimes see what's called an installation floater. And so if you're insuring your product, whatever's been installed until it's been paid out, there will not be coverage for it under the builder's risk policy. As a trade contractor, you then need to make sure you have an installation floater. So I mention this because I know sometimes architects, engineers get involved in doing some of the work. If you're self-performing and you're not listed as a named insured on the policy, that builder's risk policy, you have what's called an installation exposure, and that's something to keep in mind. So we had a claim a few years back where a plumber in a condo building had installed $100,000 worth of product. He wasn't named on the policy. He couldn't get coverage when there was a fire. And he ended up having, I think it was about a $50,000 claim because he had not been paid yet. So installation floaters kind of go hand in hand with builder's risk, but there's a difference. It's really for that specific trade usually that has the exposure till they've been paid.
Okay. This is almost a great segue. Name, because you said named on the insurance, right?
Right.
So I'm a general contractor, and we basically came up together. We're gonna have a bunch of subs, and I need information from those subs to make sure everything is covered, and also for tax reasons, right? And a lot of things that and maybe you can say this better is because we're asked this too. But let's say I'm the general contractor and asking a sub, please provide your certificate of insurance for general liability / workers' comp, and ensure that the certificate has the following on them. So I'm laying out a scenario where I've awarded a sub this job. And then I say, hey, happy that you're on this project. The first thing that I didn't mention, please see the subcontractor agreement and sign it. Second, provide this insurance, certificate of insurance. Is that connecting to... That's just me making sure that they have their insurance. Correct, right?
Right.
And then you want to make sure you're named as additionally insured for ongoing and completed operations on a primary and non-contributional basis.
All right.
There it
is. That's a big language, right? Okay. So why do we do that?
What's happening here?
Yeah, what's happening here? Let's explain that a little bit. So you're a general contractor. You want to make sure your subs always make sure you have a subcontractor agreement with your subs.
Yep.
You should be able to get this easily from your insurance company. It should be able to
from their insurance company.
They should. Well, you as a general contractor want to make sure your subcontractor agreement is a good one. You should be able to get that from your insurance company.
Yep.
That has a hold harmless agreement, and it has a requirement that they name you as primary and non-contributory language on their insurance certificate, which you were just saying. It's a mouthful. The reason for that, what does this all mean? You want to make sure that they're providing you protection for the work that they do. So if they make a mistake, you don't want it to go against your insurance. You want it to be something that you can then have your insurance company or yourself subrogate against and go against the responsible party. So if somebody, let's say if the plumber situation doesn't install something properly and there's a leaky faucet that causes damage because the pipe bursts, you want to make sure that they have coverage for that. Then you also want to make sure that they're providing you with the insurance certificate showing that you are covered.
Yep.
Okay.
So
the way to do that, though, is through certain contractual obligations, through the subcontractor agreement, and then it's actually just shown, as long as the subcontractor agreement's there, it's actually just shown through the certificate of insurance. And that certificate needs to show additional insured status, so that way you're getting their coverage if there is a claim. But we also, and this is the key point, want to make sure it shows additional insured status for product and completed operations. Mm-hmm. And that's really important because what happens a lot is that they'll be providing additional insured certificates just for the premises exposure. So just while they're there, there's coverage for you. But what you really want is the coverage for when the job is done. So that way you have that recourse. And so the insurance certificate needs to show the products and completed operations on there as well under the additional insured endorsement part of the policy.
We had a scenario that all of our listeners know of. It was burst plumbing, but this policy had a wrap. But this was during construction. So in this, and the plumber's insurance paid for it, and it all went fine. Is the way to think about it? If you have a wrap, is that more after the fact or during it, because their insurance still paid for it? Do you get what I'm saying? So then if they didn't pay for this project because there was a wrap, but then there was an error.
Well, sometimes claims get paid that shouldn't have been paid. Yes. And that was probably one of them. I remember that situation, and it probably shouldn't have been paid if everything was done exactly to the letter of the law. The plumber's insurance should have probably said, hey, this is a wrap project. We're not going to cover it. And then it should have gone against the wrap policy. That's probably how that should have happened.
Yep.
But let's just say that happened on a custom home without a wrap, then that would have been the plumber's responsibility legitimately because of the way your subcontractor agreement should have worked out. So,
yeah. Gotcha. Because here's my question. If you have a wrap project, are you getting all this? You don't need to get that additionally. You don't need to do step 2.
Yeah. So if you're on a wrap project, you're going to have a lot of requirements that the wrap insurance company is going to require. They're going to still want to make sure you're using reputable people, but the actual insurance claim itself in that situation would then normally be covered under the wrap policy.
Gotcha. Okay. What does B mean? And you can read that since this is your lingo.
It's on here. So a waiver of subrogation for general liability and for workers' comp. A lot of times there's situations where fault isn't always that clear. You may have installed, let's say you're a plumber. Actually, let's use a live example I have. I have a plumber that installed a faucet that he thought didn't quite look right, but the GC told him just to go ahead and install it anyways. Well, as a good plumber, he should have said, this valve just doesn't look right. Sure enough, 3 months later, the valve failed. Not surprised. He wasn't even surprised. He said, well, I told the guy it wasn't going to work. But because he had a subcontractor agreement, the plumber was 100% responsible. And that was because the subcontractor agreement is going to want to have that hold harmless and primary non-contributory language. And that's being shown on the certificate of insurance with a waiver of subrogation. So that means even though the plumber may not have been completely at fault, he had to take the full responsibility, even though the GC should have been partially at fault. So that waiver of subrogation means we're not going to go after you, even though I just did what I was told. I was partially at fault. I should have probably not installed that faulty part. That's why you're going to want to have that. It gives you protection as the general contractor to have a waiver of subrogation.
Gotcha.
We're going to also see that for a work comp standpoint. We often like to see that. So let's just say you gave them the construction project some scaffolding, and it wasn't good scaffolding, and it fell. They can't subrogate you. Let's say the painter who falls can't subrogate against you on his workers' comp. They just have to pay the claim, even though you were partially at fault because you provided put in some faulty and bad scaffolding.
Gotcha.
Okay.
Crazy. We also have them attach a W-9. There's a independent contractor form, but let's not get into this because I feel like we've been rolling for a while and it's all been good. And I want to make sure I cover the last part. So there is typically an audit that happens. And I feel like this audit happens both on the architecture side and the builder's side. And the two notes that I have here is, okay, if you're going to have an audit, and should architects or contractors, actually both, because I think I've seen it when I was filling out both, should we be coding our billing projects? So we say, oh, this building we have this much in condo work, this much in TI work, this much in bridge work. Because does it come back and they want to see that to see if it matches? And then the same thing too with the payroll on the builder's side. So, hey, it looks like our guys did 80% of just carpentry stuff. Or they did 50% carpentry and then 20% painting, and then, how detailed.
Well, it's funny. Earlier we talked about having two sets of books or three sets of books, right? The one guy who had one for IRS, one for his ex-wife, and one for his, like just regular books.
Yep.
Well, in this case, we do want to have two books. And we want to kind of divide our books into two different areas, general liability and workers' comp, when it comes to audits, because they just don't always blend that well together. So for the audit, let's explain what we're doing and then the why and the what. So what we're doing on the general liability, I'll talk about first, is we're wanting to go back and see what your real exposures were. So you told me, Alex, that you were going to do $1 million in sales. Did you really do that? So we want to verify that. You told me that you were going to do $250,000 in subcontractor costs. Excuse me. Did you really do that? And what was your actual payroll in the field from a general liability standpoint? So we need to go back and be able to verify those things. Your policy, when it's being presented and when it's provided, is going to explain exactly what the rating basis of the policy is, so that you should be prepared for that information at audit time. So they're going to want to verify that with your books. And then they're also going to sometimes take it a step further and say, okay, you told me you had all these subs. We also did make the assumption that they were insured subs. And they're going to want to see those certificates of insurance. That's going to be really, really important.
So that's why we are collecting them with that email right when we awarded it. Right. And you can even state, like, we cannot pay you. We cannot send out a check, your first deposit, until you give us this stuff.
Any of the large GCs today will never pay you without those I's being dotted and those T's being crossed. They want everything there because they won't release payment until that's done.
Yep.
So, you've got to have that certificate of insurance showing that your subs are properly insured, because your insurance company is providing you insurance, assuming that's the basis. Makes sense, right? I mean, they know that if you're a general contractor, you're doing a design build project, that the exposure they have is going to be, say, maybe $10 million. But they know if you've got insured subs with the proper subcontractor agreement and different things in force, that their exposure is a lot less.
Yep.
But if you start having uninsured subs, they start not knowing what their exposure is. There's nothing insurance companies hate more than not knowing what they're insuring. The audit on that is going to require all that documentation. For the general liability, that's going to be those things that they look for. Any other questions on the general liability side of an audit?
No. Well, let's summarize. So in your construction projects, in your folders, you should almost have a folder for your general liability with all your certificates in it.
Absolutely.
And then let's say you do multiple projects. You can go into those multiple folders, get all the general liabilities. They'll all be there. Group them all together. Okay, I have all this. That was part one of it. Part two was just, hey, your money, your books. How much did you write? Is that the second part?
Yeah, they're going to want to see your financial statements. That's really common for an insurance company to say, okay, so show me your P&L, your profit and loss. Show me your balance sheet. I want to see that. And then I might even want to see your sales charter of accounts or whatever. They're going to ask for that information really commonly.
Okay.
Okay.
Yep.
So general liability is pretty straightforward. But workers' comp's a little bit different because now we're talking about just a whole different animal. We're talking about payroll, right? So they're going to want to see your payroll broken down based on your different classes of the work that you do. So a lot of times it will get even very specific and ask for employee name and job duties. And they're going to want to see that broken down, especially if you're doing a fair amount of work where you're getting involved in carpentry work or any kind of trade work. So they're going to want to see that broken down by the particular employee. We're also going to want to see what you've done or what you have from a subcontractor standpoint to make sure that your subs have certificates of insurance for the workers' comp as well. Because if your subs don't have insurance, without going into too much detail, and then we want to watch the time, we could do a whole 30 minutes just on workers' comp. But your subs need to have insurance too. So if your subs don't have insurance, you're opening up lots of potential exposure for yourself. My recommendation is just to make sure all your subs have workers' comp. You're in good shape. If they don't, there's this whole thing about independent contractors that maybe we should do another section another time.
Yep. But you could go and grab those certificates from your same folder structure for your own thing. Here you go.
Right. Yep. So that's the good thing is you need to make sure you're having your general liability certs, but you also want to make sure you're having your workers' comp. Usually they're going to come in at one and the same, but they are different, and sometimes even different companies are providing them for the different trades.
Gotcha. Well, at least for this episode, that wraps it up for me. Thanks for coming, John. I appreciate it. I hope the listeners got something out of it. I'll leave it up to you. Anywhere you want to point them to get a hold of you if they want to, and any general idea or message you want to leave them with. The rest of it, the show is yours.
Well, I think it's just really important to make sure you work with an insurance company, an insurance agency that knows insurance for construction and architects and engineers. There's just too many different things to look out for. If you don't have that expertise, that's really, really a problem. So I'd say first and foremost, make sure you get an agent that knows how to do that. We would love to talk to you. Andrew is one of my commercial lines producers that is also really, really good at working on construction for these areas, and myself, and we'd love to talk to you and help you if you are interested. Feel free to reach out. My phone number is 303-292-9995, and we'd love to hear from you.
Awesome. Thanks a lot, John. Thanks a lot, John.